Hello, Warriors. Hi, Alexander, Glenn, Bran, how are you? Michael, hi, Kman, Ryan, James Groom. Everyone doing okay? One day ahead. Hello, Marcus. One day ahead of the big red number, F.A.C.E. Here's the Dow. I showed this, believe Monday when we were up there. It's following through to the downside pretty good. Still the weakest, and we're getting risk off in NASDAQ and S&Ps today. And King Dollar's trying to express itself today. So why don't we start off with the Euro and Ryan. So Ryan,
morning, mate.
How are you, buddy? So we're never able to get through a 109. I guess now the question is, does this break hold some type of fib retracement, or do you think we're going to just blow through these lows?
No, I don't think we're going to blow through those lows. Not the state of things. This looks to be a little bit of a washout from global rate expectations, shall we say, after the RBNZ,
Okay.
but a lot of end of month in this as well. So we've pulled back. The levels 108, 107.90. I think if we get a dip down to that 107.60 over the fixes of month end, I might be tempted to add a bit more to my longs.
Okay.
But yeah, see what it does after month end. But it's holding the line for now, as you've got that fib there. And
Yeah. 107.68, 61.8, and 108 halfway back. And as has been going on with EG being firm, cable leading to the downside. Well, I guess you could say Aussie is. Aussie, I think, does have new lows in it, even if the euro doesn't. What do you think?
Yeah, I think it's possible that bounce looks a bit weaker, doesn't it? It looks like a wilting palm tree rather than what we've seen in euro and cable.
Yeah. Blake pointed that out. The relative weakness showed up all week. It stalled while the other ones, were firmer. So, excuse me, 64 is a pretty big area. I think that's where the wedge comes in down there. And I've been talking 64, I don't know, since I was 64. So,
yesterday.
Huh?
Since yesterday. You're only 64.
Was that in 64?
What's that?
Was that in 64?
1964 was Ryan wasn't even born yet.
Very good year. Very good.
Yeah.
Year.
So there's that line.
My father's eye.
There's that line, and that's 78.6 back from the lows we had last fall. We'll see what happens. I would take a stab at it down there if it gets there. Yen, just holding, boring. Starting to think that this might be this triangle. And it's just something I learned from, Grega and other Ellioticians, that if this was a triangle, although we're not getting a quick thrust, that it could be, terminal, the last move out of this triangle, which it's held. Yields are down a little bit. There we are. So I'm kind of thinking we get a hot number here tomorrow, and we could try one more high for a third drive. Under 420, the picture changed. It held that 420 on the last break, but under 420, I think yields, that's the end of this rally. It's my best guess here. What are you thinking, Kman, yen and yields here?
Yen and yields. Yen, we are back, dollar yen at least, we are back to exactly where we had the Japanese CPI out. So shows the dollar resilience. Yields here, we are turning around. If you look at the short end, we are turning around the Fed dots. So again, as I was saying, it's very difficult to make up one's mind here. If we get a hot number tomorrow, of course, we can have a push through, and then the pendulum swing to the other side. Let's also not forget we are end of month, so a lot can happen and then be undone the day after tomorrow. So really, it's I think it's an open play. And then, you know, I mean, I've always been saying, I think for me, really, decision time for this year may really come in Q2 when most of them will be on the move. And until then, we could just trade ranges, even in bond markets, you know.
You're talking
What
central
stood out to
banks.
me, what stood out to me this week is that despite a huge, well, we didn't have 10s and 20s and 30s out, but the US Treasury got their funds relatively easily. It could have been worse, these auctions. So that stands out a little bit.
There's still an appetite
Yeah.
for these yields. Yeah.
And that in turn may explain somewhat the lack of follow through after printing the highs on stuff like S&P or so, because it's like different kind of money to work.
Okay. You have a vibe on risk?
No, no, I think each one for itself. Aussie, Kiwi likely still remaining under the cush, and the rest we will see. We will see what happens. Euro towards the end of its range right now. Process are not moving that much. Take away the commodities and stuff like that, but no, on risk I don't really have a bias.
Strong Canada. Canada's actually stronger than the euro, the Aussie. Well, Canada's weaker than the Aussie because it's already taking out, you know, these highs, where Aussie hasn't accomplished that yet.
Yeah, it's quite funny to see the Canada doing exactly the same move as stuff as the antipodians, right?
As the what?
As the Kiwi and Aussie.
Yeah. Why is that strange though?
Well, I don't know. I mean,
they're all commodity currencies.
Yeah, I know, but for different reasons. I mean, the Canadian dollar didn't have the CPI out and didn't have its central bank out. But
okay,
yeah.
And plus, you know,
Hmm?
I guess we have to talk about WTI. That's another reason that maybe it shouldn't be doing what it's doing. You know, it's stubborn here, this WTI, isn't it? It's really not giving up much ground.
Yeah, but then we are into pretty strong resistances over there, right?
Yeah.
Up in those 79s, it's pretty strong up there. Pretty strong.
Looks like it wants to blow through there.
Well, OPEC would love it. OPEC said that they may maintain their cuts into even the end of the year if needed. So they'd love it to break, that's for sure. But then the demand and supply is deciding differently.
Okay, so this is the kind of environment we're at. Apple did hold 180 again. They actually put in a reversal day. Do you know why? Apple bounced? Because they gave up on their 10-year project of trying to build an EV. And so just because they got out of a bad idea, people bought Apple. So it's kind of like, you know, you get out of a bad trade after 10 years and you have a relief rally. So I don't know if that's enough to turn it long term, but it was enough for it to hold again. So so let's see, we've had since its first break, 1, 2, third time it's held. Anyway, and Microsoft tried to come back yesterday, and there's still a chance that we're developing the right shoulder here. And that's all I have. It's all yours, Blake.
Whoa, good morning.
Good morning, buddy.
So yeah, we've seen well, let me just go ahead and talk really quick. I mean, as far as your Microsoft, I think that setup is pretty valid, and I think that we are in the markets that really got to start paying attention to that. You know, before we
Maybe
come
Max
back,
will even break out here.
What's that?
Maybe Max will finally get going. USD Max.
You know, I mean, I think it's waiting,
time.
and I'm gonna, I'll talk a little bit why I think
is it waiting for risk off to happen in a bigger way?
Yeah, I mean, that's pretty much it, right? So, I mean, you look at the S&P and look at exactly where we're at today. And over the last 2 days, if you are in the ForexAnalytix community, you knew this was happening. And I'm going to draw it out for you, and then you guys can kind of see what's happened. I'm just going to go ahead and do this. All right, so there's your shoulder, there's your head, there's your shoulder. And we basically have come really close to completing an intraday head and shoulder pattern, but now it's kind of formed into a like a flag, right? So we're at, you would call this a make or break level for the S&P. This is a breakout point from you know, last week. We're testing it. It's a 38% retracement. This is, for all intents and purposes, this is where the bulls will make their stand. This is it today. Like the overnight lows that we saw in futures in European trade, that should not really be violated from this point forward. That means for the rest of the day. Bulls should make their stand from here. Now, if we get back below that 50-50, 50-40 level, you know, you start, our low today was 50-54 overnight in you know, what's happening in futures. So whatever instrument you happen to be using, whether it's like the front month E-minis or whatever the case is, just look at the overnight lows. That low should not be violated. And if it is violated and we start breaking lower, because wait, we do have data today, right? We do. We have preliminary GDP and GDP prices, which obviously I think is going to be actually more important, the price index, more important than the actual preliminary GDP number itself. So if we start breaking below the overnight lows, I think that opens up for more downside. And then, you know, Dale, you like to throw this term around, and you don't do it loosely, but you use it. Throw over, right? You have a channel, you get a throw over, kind of like what we had here. I'd rather us have like a throw over and just kind of see the market melt away from here. I mean, that'd be great. I've been, you know, thinking that maybe a blow off top might come in the market, but you know, again, when you've been around for a quarter century and you've seen blow off tops or capitulations a handful of times, like literally 6 or 7 times in your lifetime, then, you know, trying to anticipate one right here, I'm like, it looks like it, but hasn't done it yet. But I'd rather just see us kind of just bleed lower and, you know, challenge this channel support. And that's possible if we start breaking lower today. And like I said, we have data that could do it. You know, if the preliminary GDP price index comes in a little hot, you know, or maybe, you know, I don't know. I don't think wholesale inventories are going to do anything, or, you know, whatever. But I really think the preliminary GDP numbers could be the catalyst that actually pushes us through those lows. And if that's it, then, you know, we might actually see a little bit of risk off. And if that's the case, Dale, yeah, you might actually see the dollar Mexican peso, you know, peek its head up. But we're also seeing, and, you know, we're seeing the weakness in the Canadian currency. We were just talking about, or you guys were just talking about the Canadian, the Aussie, the Kiwi. Look, the Aussie and the Kiwi have very good reason to roll over. And you're right. And, you know, we've been talking about it. The very glaring underperformance of the Aussie. I've said this to all the ForexAnalytix traders. You all may have heard it here over the course of the last couple of weeks. Well, when stocks roll over, I don't even care what the Aussie's doing. I'm just going to short it because it just doesn't do well. If you have been buying Aussie dollars because stocks are at quote unquote all-time highs, you are absolutely getting your ass handed to you right now. And you don't even know what to do with your long positions at this point.
Someone handed it to me, but I dropped it.
Yeah, exactly. So, you know, you take the Aussie, which tends to go here. Let's just you know, most of you kind of know this, but let's just make sure you do know this. Here's the S&P. And you've seen the massive divergence between the S&P and the Aussie over the course of the last several months. And this is so glaring to me right here that, you know, if we actually do see stocks go down, the Aussie is going to go down, and they'll eventually meet back up and start to recorrelate, but the Aussie can't get out of its own way. And then, you know, obviously, you know, data overnight's weighing on it too. And then we had the RBNZ with OR, you know, market got OR'd. I'll come back to that pun in a bit, but you know, Kiwi's doing the same thing as the Aussie, and yeah, we do have the Canadian. The Canadian actually, no, I know you had Adam Button on here.
You did,
and I had him on like I think a week. I have him.
Monday.
Well, you can watch the interview right here. It's from last week. He's you know, the title of this one is "I have never been so bearish on the Canadian dollar." And that's from a Canadian. So, you know, you watch the dollar Canadian, it's breaking out of this triangle, which it broke yesterday. So if you guys didn't know that the you know, dollar Canadian was breaking out yesterday, it was. Here's your 4-hour, whoops, there's your chart where it was breaking out last night. So, you know, the Aussie, or excuse me, the dollar or the Canadian looks weak. It's playing catch up to everything else. Look at Norway. Norway's another one of those situations. I know Stelios isn't listening in right now, but whenever Stelios comes on, his first thing that he says is, "I need to buy some silver. I'm bullish silver," right? That's Stelios's shtick, if you will. That's what he does. His next thing that he does is, you know, "I don't understand why the Norwegian krona is so weak." I think anybody who's buying Norway right now is probably, well, over the course of the last, you know, 6 months or whatever, they're probably feeling the same way. The US dollar Norwegian krona is not far off from its, like, you know, all-time lows, meaning the US dollar Norwegian krona is not far from its all-time highs. How in the hell that's even possible, I'm not really too sure. But this thing is very, very sticky. So, you know, you got these commodity currencies that all look really weak: Aussie, Kiwi, Canadian, Norway. You know, if the stock market starts to show some weakness, these commodity currencies are going to get wrecked. I know at some point they are going to find bids, but I don't think it's anytime in the near future. Anyway, well,
I have a view on gold. Ugo is asking. It's hard to have a view. It's doing nothing. I mean, all the movements in silver.
It isn't doing squat. I mean, it's in this descending channel, which I think it's capped at 250, and I think it, you know, finds buyers at 2000 and 1985. That's really my in-depth analysis of gold. I don't want to buy it because it's given us so many false breakouts above 2070. I mean, I understand all the reasons why you want to be long gold. I understand all the reasons why gold should break out. I understand all the reasons why I want to be a buyer of gold on dips, but it's just not dipping. So it's kind of like in no man's land where like you have to own it because you know at some point it's probably going to break out higher. But at the same time, I can't sit here and look at it and say, well, I don't think you know, I don't think it's going to see 2000, or I don't think it's going to see 1900 before it sees, you know, 2200. I don't feel like it's going here or here or here or here first. It's kind of like in no man's land. So, you know, have fun trading inside of that range, because I'm sure if you are a long in gold or you are a short in gold, you are probably having one of the most frustrating several months of your life. There's, you know, look at what we've done since the beginning of the year. We haven't done shit. So anyway, that's my overall thoughts on gold.
How about Dixie, Blake? Do you think we're going to take out that 105 high?
I do. I do. I think we still have this inverted head and shoulder pattern. This is the just so everybody can see it. Here's your one from earlier this year, right? This is the minor one, right? That completed at when we hit 105, right? That minor one completed.
Right.
And we have this bigger one that's still developing. And as long as we're above 103, I can't see a reason to be short dollars. Now, you look at just what happened with the with the Aussie.
Aussie.
You know, the
Yeah.
year-over-year CPI last night came in 0.2 worse than the analysts had expected. It was in line with the previous reading. The RBNZ got smoked. It'd be getting smoked overnight. The euro dollar is trading pretty heavy, and I think as we probably move forward over the next 60 or 90 days, we're probably going to find out that the ECB is much closer to cutting rates than the Fed. That's probably going to weigh on the euro. I can't find any reasons to be bearish dollars. The only reason, in my opinion, why the dollar isn't rallying right now, much more than you see it, is because stocks are ripping the all-time highs every day. So while stocks are at all-time highs, it's really difficult, in my opinion, for the dollar to get much move on. But I have to say, it sure is acting really well based on the current environment. So that's my opinion there.
Thank you.
So,
and that measures like 108, doesn't it? The bigger
yeah,
head and shoulders.
Yeah, I think it measures back to re-challenge these highs. And that's not, you think about that, guys, what you're looking at with the dollar index. The dollar index isn't telling us that we're going to somewhere that's uncharted. Like, oh my God, I can't believe the dollar index is going back to 120.
Right.
No, I mean, this inverted head and shoulder pattern just takes us back to range highs, which, 107, 107.50 is not like undoable, right?
Right.
That's very doable. That would take the euro back to 105.
Yeah, take every dollar bear out of it.
Oh, yeah, I'm sure. All the ones are calling the death of the dollar, and it's going to get, the new BRICS currencies coming in, and what about the deficit spending, and the dollar is going to get demolished, and I'm sure every dollar bear right now is looking at stocks at all-time highs, thinking the same thing. I can't believe the dollar is as strong as it is.
So you
got
really
to put
don't
yourself
buy
in the shoes. You got to put yourself in the shoes of everybody else. Like,
yeah.
Think about what the dollar bears are feeling right now.
Yeah.
That's
why the close under 103.80 was so important, and it never did. So, that 103.80 support level, it never closed back underneath it. It traded underneath it, but it didn't close underneath it.
Yeah. So,
that's my level.
Carl makes a great point, and I think something we do really have to pay attention to. Today is the 28th. Tomorrow is leap year day, right?
Oh, yeah.
It's leap year day. It's the 29th of February. But it is also the end of the month. And so we are expected to have some US dollar selling going into month. Ryan, Kman, have you read anything different? Have things changed? I mean, because we've had so much, inflows to equities that it's natural that you're going to have dollar outflows. Ryan, how are you feeling right now? Or have you read anything?
No, I'm going to hand it over to Kay. I bury my head in the sand over a month end, and I let the guys in the flow room dig those skeletons out. So yeah, I'm passing the buck to Kman.
Kman, what are you thinking?
Yeah, that's what the models are saying. So but we know for months and possibly even longer that those month-end expectations are, well, over the year end it was good. January was all right, but this is February, not a quarter end, not a year end. And there's a lot more dynamic hedging going on. I'm not sure whether we can hang our hat onto those month-end models for much longer, because people just hedge it as it comes. I know for a fact that some big money managers are hedging a lot more dynamically, so that waters down some of those month-end flows. We may still see some this afternoon, tomorrow, into the 4 p.m. London fixing, but I'm not sure to what extent they are really going to to impact that much, you know.
You know what gets my attention, Kman, when you because you know we read a lot of you know what's happening at month end. And by the way, if you guys don't know this, if you're in the Forex, this is the Forex Analytics community. All right. So if you are in, this is us in the trades or in the general chat room, just so you know. And, you know, we have a lot of little side conversations going on in these just general chat rooms. You can see these are all, you know, side threads off of these threads. Then you have like your trades room. Like you can see where I was buying last night, added to Euro Aussie longs following the CPI and shorted Aussie Kiwi last night. These are the trades rooms. But if you go into the news and research room, this is where, you know, a lot of us will post articles that we're seeing on, you know, Bloomberg or wherever, and, you know, updates to, you know, some of the flow that you see in the market. So if you guys are not involved in the Forex Analytics community, this is, you know, not only do you get this really awesome platform here, but then you click this button right next to your icon and it takes you over to the chat room. So you can be inside of our community and be talking with myself and Kman and Ryan, you know, throughout the course of the day and all through European trade. Anyway, the reason why I mention this is because Kman, when I'm reading through what, you know, we're seeing as end of month or end of quarter flows, what really gets my attention is if it's universally very, you know, bearish, but you see it's also, you start reading excessive, you know, when you know that it's like excessive or expected massive US dollar selling at month end, you know, and you're reading it in multiple sources, that's when it really gets my attention. How about you?
Well, I mean, the ones that that really, I mean, if you want to read some that really should be read, is just the bank research, the bank strats. They model those things. It's all based on models. It's not something that is just coming out of the blue. And those models, they worked well, very well for a number of years. But now, since, as I was saying, since there's money managers and asset managers do it differently, they cover it differently because they can do it electronically, they can do it themselves instead of having to give orders to banks. Yeah, the effect is getting less, where it works for a number of days. It actually works when it just gets published also. Then it seems to work for a day or two, like yesterday, the euro dollar, or the cable or whatever. But then once we get closer to the end, I really think we should know what they say, but not necessarily trade on the back of it anymore, unless you see the move. Actually use it opposite way. Like, for instance, if you're bullish dollars and you see a spike in the euro dollar tomorrow at 4 p.m., I mean, use that spike to re-enter short if you're bullish dollars. That's an example. If you're bearish dollar yen and then all of a sudden you see a spike tomorrow because the expectations are for yen selling tomorrow, you can use that to
it allows you for better trade placement, basically, you know, is what you're saying, which makes a lot of sense. It's allowing for better trade placement.
Yeah, so that's it. You use it as an opportunity to give you a better level if that's the way that the flows are going to go, instead of trying to front run them. And the front runners of those flows have been frustrated.
Right. And
it already happened yesterday.
Sorry, we got about a minute before the data comes out. Actually, we got just a few seconds, about 45 seconds. But that's what Kman's saying. I think makes a lot of sense. Use it for positioning. Like, for example, we have the PCE data coming out tomorrow, or actually tomorrow. You know, if you're trying to position ahead of PCE, using that, you know, that data to kind of get you in at a better level, what you're learning from, you know, flows, that might do it. Hey, look, we got GDP data coming out here in just about 20 seconds. Any last minute thoughts?
Second reading in this, okay? It's not the first reading, it is a second reading, okay?
And focus on the prices data, this price index, which you know, that's probably where most of the focus is right now. So heads up. Got the dollar index here, S&P right in the middle, and yields over to the right, just for instant reaction. Canadian current account. Price index is higher. So let's see if the dollar
GDP a pip softer.
Yeah. But you can see the dollar is firming up, yields are firming up based on that price index. So we are seeing a little bit of a reaction here. They don't care about the weaker, second estimate that you're seeing here. They care more about that price index, and that's gonna factor into keeping the dollar firm going into today. I don't know if that's that should keep a lid on equities, but just remember equities are a pretty key support. Again, I'm going to reiterate this if you guys missed it a little bit earlier. This is a flag pattern developing. This is a 38% retracement. This is the previous high from back on February 12th. Okay. We got a little bit of a throwover, but we've drifted to this 38% retracement. The S&P's got to hold here. If we start seeing a move below, I would say 50-40, maybe 50-30s, you're probably going to see some selling, step in. You're probably going to get some stops triggered and whatnot. So just keep your eye on the S&P at these levels. I think there's really, really key hold that we had overnight. Kman, thank you for your explanations on end of month flows. Ryan, always good to hear your voice. And Dale, thanks for guiding us today. And I know you have an interview right now. Who do you have today?
Carly Garner.
I love
Excellent
Carly.
technician.
Yeah. She works with Jim Cramer, right?
Yeah.
Is that correct?
Yeah. Well,
right.
Jim features her work. So, she must have some pretty good stuff to get that type of exposure. And she's made great calls. She's been coming on here for a few years now. Welcome back, Carly. Oh,
thanks, Dale. Good to be here.
Yeah, great to have you back. Before we get going, I want to thank the team. Thank you, Kman. Thank you,
Thanks,
Ryan.
guys. Thanks for joining us, Carly. Guys, have a great
absolutely.
interview.
All right, Blake. Thanks, and Carly. So, what's on the docket?
Okay.
And
all right,
how have you been?
I've been good. Thank you. I hope you can say the same. You ready for me to share my screen?
Oh yeah, really.
Okay.
Ready.
Yep, let's do it.
Did you ever think the grains would get this cheap, Carly?
I've been soybeans, yes. Corn, no. I was probably about 30 cents early to call the bottom in corn, and 30 cents in corn's a lot, or historically. All right. Okay, so here's what we've got. I'm going to start with natural gas just because I think that one's pretty interesting. Natural gas has been really, unless is that okay to start with natural gas?
Oh yeah.
Okay.
It's important.
Yeah, this is a monthly chart of natural gas. This is the one market, I mean, they call it the widowmaker. There's a good reason for that. It truly is. But it's such a fabulous example of how commodities operate. They boom, they bust. I don't think that's ever going to change. Most commodities, because most commodities, when prices get high, people stop buying as much and producers produce more, and vice versa on the bottom. So you just always get this sideways boom or bust. The booms can be stunning and the busts can be devastating. It is what it is. This is a chart that dates back to like early 2000s in natural gas. And you can see, if you remember a year and a half ago or so, we were trading around $10. And at the time, literally, I'm not going to say all analysts, but almost all analysts were thinking $20 because nat gas in Europe was trading at $20. Right. People were spending insane amount of money for call options above the market. Like I remember seeing, and I remember because we were short sub and I just could not believe the stuff I was seeing. Like people were spending $4 or $5 grand on $20 calls with a month to go, a month expiration. I mean, just complete insanity.
Sounds like NVIDIA. People buying $1,300 calls.
100% is the same thing, but we see how these things end. Now it doesn't end, immediately. Sometimes it goes longer than we all expect, but those types of things, that kind of euphoria, I've never seen it end well. It's usually pretty ugly, and this is exactly what we're getting.
Yeah. So now left. look left at all that. That's like
look at this.
historical support that we're on.
Correct. Now this box here, this is before fracking. Obviously, fracking has been a game changer. It has tamed the market a little bit, but we still get these big bumps. I think we're going back into this stage as opposed to this stage. So when we had a rally a few weeks ago, people were starting to buy $6, $7, $8 calls. I could see it in the tape, and I was just thinking they're thinking about 2022, 2021. They forgot that we spent a decade trading between like $2 and $4, and that's probably what we're going back to, is this kind of scenario. But we are sitting on very long-term support. So we like playing the upside in that gas from here.
How you doing it? How you doing it with options?
So we'll probably put something fresh on today. We'll probably do some sort of a bull call spread with a naked put. So probably looking at something, this is just hypothetically selling like maybe a 170 put, 175 put in July, and then using whatever we collect to buy some sort of call spread. The days of getting really fat call spreads are probably over because the premium just isn't there, but you should be able to get something like a 250, 275, maybe 280 call spread. So that's $2 or $3 grand profit potential. And if you sell a put to pay for it, you're getting a free trade. Of course, you're accepting risk under the market, which you never know. I mean, we saw crude oil go to zero, so maybe nat gas goes to zero. I don't think it does, but I'm not going to say never.
How much time do you buy? So you'd go out to July. That's
I'd probably do
normally
July.
Normally in your options trades, and a lot of people, and I know that things that we look for to happen seem to always take longer than we think they're going to, right?
They do. Yeah.
So, people cut themselves short by not buying enough time because they don't want to pay the huge premium in time. So, you kind of soften that by doing verticals where you're taking in premium. Plus, you go out and fund it with if you're bullish, with a put on the opposite side. So do you normally go out like July is 6 months away, 5-6 months away?
July is about 120 days. I've got the chain up here. And actually, I misspoke. We probably would be selling something closer to a $2 put if we went to July. I was thinking the June prices. But in any case, we'd be doing, I'm going to show you real quick a trade that we have that's very similar, but in a different market. So you get an idea. But the idea is we're trying to sell enough premium to purchase whatever options we want. There's good and bad to that. I don't have time for all the nuances in this type of a presentation, but if you go to our website, we have a lot of information on that. So I'm going to just pop this over here. We are bullish treasuries in the short run here. Well, actually in the long run too, if you really want to go there, but we think treasuries, like this is a daily chart, kind of holding a line. We've retraced nicely from the wild rally that we saw in December. And I think that's what needed to happen. One thing about treasuries is for most of my career, treasuries have been a very boring market. Nobody talked about it. Nobody wanted to do anything in there. The last couple of years, we've had a lot of volatility. I think we're probably going back to boring. And so we're comfortable doing trades like this because I don't think we're going to get anything like what we saw last year. I think that was one and done. It was very unusual. Probably not going to see that again. So we're pretty comfortable selling premium to pay for option spread. So in this situation, this is the same strategy that I was just mentioning, but you can see how it might work. We're buying and we put this trade out to our clients a few days ago. So for educational purposes, I'm sharing it. We're buying a 120 call in June, selling a 123. So it's a 3-point spread. It's a $3,000 spread. So all treasuries have to do is kind of bump back up into this upper Bollinger Band. Even if it's in a downtrend, there's a pretty good chance we get somewhere up in this vicinity.
Yeah.
And we're using a 112 put to pay for it. And I think we're getting filled at basically even money, maybe paying a tick or two. So it's essentially a free trade as long as we are comfortable accepting unlimited risk under 112. Haven't spent much time under 112. This spread only has about 90 days to expiration. So
so the put that you're selling should melt. We're into the decay period.
They should. Yeah, they should melt. I mean, the only way these are only going to, a trade like this, you can make money if you're right, obviously. If you're wrong, it's kind of no harm, no foul. Basically everything expires worthless. If let's say the market were wrong, but the market trades somewhere between 116 and 112 at expiration, we're no harm, no foul. We didn't really lose anything, maybe our time, but that's about it. The only risk in a trade like this is if you're just really dead wrong. If we're dead wrong and the market slides below 112, we're in trouble. So that's where it goes. But to be honest, if we got under there, I wouldn't mind being long a futures contract, which is essentially what that position would become.
Interesting. So I know that was a trade, but when you look at that, you said long term too. Do you think we're going to take out those highs, even though your strike on the call you sold is right around there? Those highs?
I do. I'm going to show you a long-term chart in just a second here. Let me grab it. And I'm sorry, I'm placing a trade real quick for a client. Sorry.
It's okay. Carly live.
Yeah. That's the thing about being a broker. Markets don't close for us. We're always in the thick of it.
Do you get to sleep?
Okay. Not much, to be honest.
Okay.
Okay. All right. If the markets are quiet, I can comfortably sleep, but I'm always wondering what the heck's what I'm gonna wake up to. So, okay. All right. So this is this is a 30-year bond chart, monthly, and we can see. I call this the Fed instability mandate. As soon as the Fed started interfering deeply with things, they did it to contain volatility, but you can see that's not what happened. It's been just a Wild West show since. Last year we had obviously this, basically a crash in treasuries. That's the only way I can describe it. And we've kind of come up above this long-term trend line. Hopefully you can see that. Let me see if I can zoom in just a little. And we're just I'm going to move this so you can see what's going on here. This pullback from January, February area has kind of put us right back on the long-term trend line, which I believe has a pretty good chance at holding. I mean, you never know, but I think I look at this as kind of the breakout of the downtrend, and now we're just retesting that breakout. That's very common in markets. If I'm wrong and this level breaks, then all heck could break loose, and we could be looking at like 105 in bonds, somewhere in there down here. I don't think the odds of that are very good. I could be wrong, but I think we hold here and then we kind of move our way up into like the 130s, 140s in bonds. And what that would mean is, I mean, we're not going back to 1% interest rates or on the 30-year, maybe 2 or 3, but we could easily see, on the 10-year, I'm thinking, honestly, in the 10-year, let's look at that real quick.
320. Oh, okay. I'm thinking yields.
Yeah, no, yep. I'm talking yields as well. My fault. So this is a 10-year note, which is a little better representation. You squeeze that a little more. I think we could see at minimum 3.25 or so, somewhere in that ballpark. In the 10-year, I wouldn't be shocked to see 2% again. I know that's not really a common outlook, but let's face it, 5% wasn't a common outlook over here, but yet again, yet that's what happens. So sometimes markets do really wild things that most people don't expect, but that's just how it works. There's a lot of money on the sidelines searching for yield, and if anything goes wrong in the equity market, treasuries are a pretty good place to be.
Yeah, they want to capture yield, have a chance for capital gains instead of just sitting in 5% money markets that could go away.
Correct. Yeah. And if the Fed starts lowering, those money market yields are going to drop from 5% to whatever. I mean, we've been there, done that before. It happens very quickly. So I mean, treasuries have not been a great place to be the last couple of years, but I think that's going to change. And I think people will start to appreciate them again. And speaking of the stock market, actually, I'm gonna share the NASDAQ chart first. Picking tops in the stock market's a really tough game because the stocks almost always go up over time, and we get these type of euphoria situations like, in my opinion, we're in now. that they're unsustainable most likely, but they can go on for much longer than any of us could stay solvent. So I think that's the situation we're in. This is a NASDAQ chart. This is a NASDAQ futures chart. You can see if you draw a trend line from the 2000 high, so basically the dot-com bubble high, through late 2021, it comes in right around 18,000, which is where we are. Maybe we break through it and keep going, but I have very serious doubts. I feel like the odds are in favor of a pretty nice correction here. Not only are we seeing some technical resistance, but the RSI is a little suspect when you see the market making new highs. This is a new high from 2021, and RSI isn't following.
Glaring.
It's a really big red flag. Now, that doesn't mean we turn around today. Maybe it's a month from now, maybe it's 2 months from now. But the odds of us continuing on this upward trajectory without some sort of digestion is pretty slim. So,
okay, you have a view on the dollar?
Let me look. To be honest, the dollar is kind of just in the middle of nowhere.
Okay.
This is my chart. So at this point, I think we're probably gonna. I mean, to be honest, I don't have a strong opinion either way. We're right in the middle of my support resistance areas. I'd be a big seller at 107 if we see it. Probably a buyer at 99 if we see it, but between there, just kind of noise.
Okay. Anything else? I mean, gold has been comatose. You have any lows that you see due in silver? And do you follow the miners at all, Carly? No, you mainly do commodity futures. So
I don't do a lot with the metal. You can see this chart I haven't updated in a while because look at the silver's just gone nowhere. There's really, I just kind of stopped looking at it until it starts doing something. So I really, silver and gold, I both have a positive outlook. Like the previous speaker mentioned, makes sense to be a buyer on dips, but like you said, it's not dipping. So, I mean, I think other than one thing I can say about gold is the options are unusually cheap right now. The volatility is as low as we've seen in several years in gold. So if you did want to play the upside in gold, you can buy some cheap, like 2,200 calls, something like that, just to have a foot in the door. So if something erupts, because the thing about gold is it'll do nothing for years, sometimes a decade, and then it makes its move all at one time. And if you're not in, it's hard to chase it. But if you are in, it's hard to justify it because gold doesn't earn interest. You're using that money in a market that's going nowhere when other things are moving. So it's really hard to justify holding on to a whole bunch of gold. But you could buy some cheap calls right now. There's some opportunities for that. Call options are obviously, I don't want to say lottery tickets, but that's kind of what they are. You pay a limited amount of money and it either happens or it doesn't. You did mention the grain. So let me pull up the corn chart here.
Yeah, we're getting a reversal week. Is this a weekly? Yeah.
Yep, this is a weekly. I think we're about done in corn. I thought we were done on this trend line. We started playing the upside here. It failed, but there was a lot of farmers in the cash market that were holding on to their grain, hoping for higher prices. And I think, unfortunately, there was a lot of panic selling in the cash market that caused this. Also, speculators are sitting on one of the largest net short positions ever in the grains. And so everybody's short. Cash markets probably washed out a lot of the extra inventory, not all of it, but most of it. And we're going into planting season, and a lot of things can go wrong, and 430 seems really, really cheap for corn. At least this time of year. So
the wheat has a little better structure than corn and beans. It's still holding the lows.
It does. Let me see if I can squeeze this in here. So wheat's been, all the grains have just had the problem is wheat and corn can't bottom until soybeans bottom. And I think we're finally starting to see a low in soybeans. We've been calling for somewhere between $11.50 and $11 to be the low in beans. Jury's still out whether that occurs, but I think that's probably what's in the cards here. Also, this week is first notice day. So March contracts go into expiration, and a lot of times you see market reversals around first notice day because for whatever reason people wait. People that are in bad trades, let's say people that were long the grains, they hold on to the very last minute, and then when their broker says, okay, you have to get out, they get out, and a lot of times they don't get back in. So it's almost like they drag the market down, and then once they're out, the market's free to go back up. And so that's a lot of times what you see.
Why don't they build a silo and take delivery?
Well, I mean, that's one way to do it.
Okay, so I think that, I mean, cocoa went bananas, coffee shaping up, cotton shaping up. Are you pretty much a commodity bull? Look at cocoa. Wow.
This is cocoa. This is silly, and this has actually been really sad. I hate to criticize the exchange because there's only 2 exchanges in the United States, and as a broker, I can't really be on their bad side because it's my business. But I really feel like the ICE exchange dropped the ball here. They just did a very poor job. Cocoa margins down here when the markets were quiet were like $1,800 per contract, and that was reasonable for that type of market. They kept the margin at $1,800 until about here. Well, what happened was everybody built up massive short positions, like just massive, because the margin's so low. So they underestimated the risks. And once all that, all the small specs and people that just, were on the wrong side of it had huge positions, they doubled the margin overnight, and then it just became out of control.
It's like the nickel market a few years ago.
So a lot of this is probably, I mean, I'm not saying cocoa wouldn't have went crazy anyway, but it probably would have been contained somewhere in here, not up here. This is just insanity. And so it's too bad. I'm sure a lot of people ruined their year, probably maybe even their life, which is horrible. Really, yeah, it's sad. Yeah.
All right. Anything else you want to?
No, but for the most part,
showed us a lot. You want to show your website, Carly, and
sure, so let's do that.
People view this and have an interest in trading commodity options, all options, futures options. Carly has her own branch.
We do. So we're a branch of Zaner Financial Services. Zaner's located in Chicago. It's so much warmer in Vegas, so here we are. But DeCarly Trading is the website. And if you're interested in just learning, I mean, we're a brokerage service. If you're interested in learning about the markets, we have lots of free educational videos, articles. If you're interested in learning about our services, that information's there too.
Carly is a consummate pro.
Thank you. I appreciate that.
And always look forward to talking to you, Carly, because you bring, you don't do typical. I was on an interview yesterday and I gave my version of typical CNBC analysis, and they would say something like this: well, natural gas is at historical lows. It could rally unless selling comes in to take out the lows, but if it reverses, it could go higher until it fails again. I'll trade that. Trade that.
Yeah.
Anyway, well, you take a stand.
Well, thank you. I try. Sometimes I'm wrong, and that makes taking a stand not so fun, but it's okay. Well, it's part of the game.
It is. So, Carly, I hope you have a great 2024. We've been talking for a couple years now, 2-3 years.
Yeah, I think at least 2.
Yeah. So I really appreciate your contribution to informing and edifying the F.A.C.E community, and hope that 2024 is one of your best years ever, and not just in the markets, because trading is what we do. It's not who we are.
I appreciate that. Thank you. It's been my pleasure.
All right, Carly Garner, everybody check her out on X at Carly Garner.
At Carly Garner, yes.
Yeah, and check her out, her website. Great research. This is just the tip of the iceberg, what she showed us today. And people are thanking you, Carly, and that's going to be a wrap. So don't just count your bonds and natural gas and grains, count your blessings, and you could join the team in about 20 minutes. Adios, everyone. Good hunting. Have a good day. Thanks again, Carly.
Thank you.
All right. Adios, everyone. You're welcome.